You're listening to the Reinvest Podcast, where each Tuesday we show business owners and entrepreneurs how to diversify into real estate by equipping you with the tools and tactics to build generational wealth. Your hosts, Garrett Gatton and Seth Ciminillo.
Welcome back to another great week. We are in full swing here. Christmas is right around the corner. And it's been getting cold here in the Midwest. We've been having a lot of snow and stuff like that, but it's good to have you guys with us today. And I'm really excited for today's episode. We have Bob Fraser with Invest Like a Billionaire podcast and also Aspen Funds, co-founder of Aspen Funds. And so we're really excited to have you with us today virtually. How are you doing, Bob?
Yeah, super. And great to be here.
Awesome. So off camera, you had told me that you are from Kansas City, or right now at least in Kansas City.
That's right.
Is there much snow over there?
Nah, it's dry as a bone.
Dry as a bone. Well, we all can't be as lucky, I suppose. Do you guys get much seasonal snow?
2 or 3, maybe 4 snowstorms in a season. That's it.
Not too bad. Pretty mild. It was 5 degrees here the other day, so that kind of gives you an idea of what we're dealing with. But we all can't have the sunshine. I feel like more often than not, when people I talk to on the podcast have already relocated to like Florida or something, and I'm like, guys, got to have some faith elsewhere in the country. So, but
I'm going the other way. I'm going to Breckenridge.
Okay.
Let's embrace the snow and have a good time skiing. So
yeah, if you like skiing, that would be a good thing. Well, it's good to have you. Before we really dig into it, I bet most of our audience maybe doesn't know who you are and what you do. So go ahead and give us a snapshot of who is Bob Fraser and how did you get here today?
Married 41 years, got 4 kids, started as a computer scientist and a programmer, built a .com in the 90s that blew up and then blew up. And it was that led me into get started in alternative investing. And then I built with my partners Aspen Funds.
That's really interesting. If we can just go back to the .com company that you created, what was that like at that time to create something that was seemingly, apparently successful before the .com bubble burst? I mean, what was that like for you?
Well, you can imagine. I mean, it was riding the wave. I mean, the .com boom was unlike anything that had ever gone before. And I mean, the level of excitement was on par with what's happening now in AI. I mean, it was just everyone was super excited. Lots and lots of money flowing into the into the space. Everyone wanted a piece of my company. And, I'm on the front page of the paper and, so it was incredibly exciting. And then the air went out, and, we all of a sudden everything started reversing and I was late to figure it out. I'm like, oh, cool. Whatever. The stock market went down and it didn't realize that the party was over. I mean, it was over. And that was the beginning of the end. It took about a year for everything to wind down. And then, I mean, I really got lost for a little while, trying to figure out what to do with my life. And, like you can imagine, I mean, I was a multi-gazillionaire and on paper and then not. And,
kind of saw everything crash down in a short period of time.
Yeah. And and I'm on the front page of the paper going down too. And so a little bit of a byword. And then, the same people that were begging for 30 seconds of my time wouldn't even return my phone calls,
Wow.
And so it was, you figure out who your friends are and you figure out what life is really about. Is it really about, a minute of success or is it, more important things? So yeah, it was a defining time, no question.
Yeah, that would be crazy. I kind of joined the investment game, pretty recently, within the last 5 years. 2020, I bought my first investment property, but I've talked to a lot of people who even went through whether it was the .com bubble burst or the housing market crash. If they were already heavily invested in kind of what that was like, and it's been really interesting to see the people that eventually make it on the podcast, they didn't give up, number one, and they kind of found their way in something else in one season or another. So how did that experience kind of lead you into what you're doing now? And maybe explain for the audience, what is Aspen Funds and what do you guys invest in?
Yeah, and it really was directly responsible for me doing what I do now. And it's super important. Everyone's going to have setbacks, and it's really important to have resilience and to bounce back and don't let things get in your head. So I was looking for something with more control, right? The stock market you have no control, right? There's just nothing. You can't make that market go up or down. And it does pretty much nonsensical things most of the time. And so I was kind of done with it after that. After the dot-com crash, I became a professional stock market trader. So I traded portfolios for other people, had a lot of success until the great financial crisis.
Okay.
And then I lost everything again. And at that point, I was done. I'm like, forget the freaking public markets. I want something I can control. You look across the street and there's an apartment complex. And did those people pay rent through the dot-com crash? Yes. Did they pay rent through the great financial crisis? Yes. And did that apartment complex, did it vaporize or disappear? No, it's still there. And so I was looking for things with more sustainability and found my partner who was an expert in real estate. I was never really much of a real estate guy, and I became a finance guy through the whole process. I kind of, I got what I call a street MBA, right?
Yeah, there's a level of sophistication that's needed to start a company. And you're wearing all the hats, and you're hiring the people, and you're learning the financial statements, and so you learn pretty quick.
I became a finance guy, and then met my partner who was in real estate, lost everything in the great financial crisis as well, and he figured out how to buy distressed debt. So he was buying defaulted residential mortgages for pennies on the dollar, and figured out how to work them out. And it's a financial chess game. It's very, very complicated. And I was the guy who figured out how to I know how to scale businesses, know how to raise capital, and know how to build systems and processes. So I'm really operations focused. Mm-hmm. And so we partnered up, and it turned out to be a match made in heaven. He was just this genius that figured the stuff out, and I figured out how to grow it. And so we started returning a lot of capital to our investors, and super successful, even in the midst of this horrendous crisis. There's always something that's working, right?
Yeah.
There's always something. It doesn't matter what time it is. It's always something that has a great future. You just have to figure out what it is. And so during that whole process too, I became passionate about understanding, well, what is it time for, right? What is it? What is going to be great going forward? And that's led us to this very diversified approach at Aspen. And we create investments. We look at the macro picture of the world, the globe, right? What is going to be good, going forward? What are places to place capital where you have an outsized chance of winning, right? Mm-hmm. And a better chance of not losing. And then we figured out how to structure investments. We come up with what are the best strategies in those trends, and what are the best strategies and structures. And then we form funds and place capital. So we've got about 27 funds that we've done. We've got about 14-year track record, and raised hundreds of millions of dollars in capital for investors. We've returned $85 million to investors.
Yeah, wow.
So far.
Those are some big numbers. Yeah.
Yeah. So
you guys don't strictly do real estate, though. I mean, do you do alternative investments, or is it only real estate?
Definitely all over the map. Real estate is great until it isn't, right? It's like everything. It has some superpowers. There's no question. It's a good place to be. But look what's happened. Yeah. In 2022 and 2023, when 2022 was great. Then 2023, they raised interest rates 11 times in one freaking year. and crush the market. And values drop 25 to 35%. Anybody who's slightly over levered or all the weekends, start falling out. And so that just begs my point. It's like real estate is good until it isn't. And so really what's needed is a diversified approach.
Yeah.
You need many kinds of real estate, and you need other things besides real estate. And so that's our focus, is we're doing lots of different things. So we do real estate, and we have 4 flavors of real estate we're doing. We also do private credit, real estate private credit, and we're also doing oil and gas.
Okay.
And someday we'll be doing private equity and other things as well.
Yeah. You guys, any part of your portfolio still go towards distressed asset or distressed notes like what you were doing before, or is that all phased out?
The opportunity is gone. There's just, you really can't buy those products anymore.
Yeah.
The bank, there's just not a lot of distress in the markets, believe it or not, and what distress there is, the banks aren't selling the notes anymore. So it's very difficult, So we are currently operating several distressed debt funds, but they're in harvest phase. They're all winding down.
Okay.
We do have a large income fund that buys reperforming paper, and it's so it's got a fair amount of distress in it, but it's distress. It was once distressed, right? This paper that was once distressed that's worked out, and we love that. We buy that stuff at a discount, and we have, that's our core competency, is working out distressed debt. So if they pay us, we make money. If they don't pay us, we make money. So, it's a great fund. And that has about $100 million in investor capital in it. And it's been operating for 14 years. It's audited, pays 9%, Wow. It pays monthly. It's just a little
stable,
wonderful, wonderful fund.
Yeah. That's awesome. Well, for our main topic, that's some good background, kind of gives everybody kind of a good idea of where you guys are at. Invest Like a Billionaire podcast. So that's your guys' podcast, and then you just told me that you guys actually released a book. And it's just called Invest Like a Billionaire, correct?
That's it.
Okay. Well, really great title, really catching. Everyone's kind of like, how are the wealthy, people that are wealthy just do things different. And so, I think everybody's like, how do you get to that level, or what are the principles that you need to know to get to that level? And so I kind of wanted to hone in on, why did you even title Invest Like a Billionaire? Where did you come up with that idea and to execute the podcast?
And, great question. And it's really ties into everything we've already just talked about in my history. So we are absolutely passionate about helping investors play the game better, right? And be smarter. I've lost everything twice. I've watched my family and friends lose everything multiple times. And I really want to help investors do a better job. And the billionaires invest differently than everyday dudes, okay? And here's the biggest difference. Now, in 1985, the institutions, the pension funds, the endowments, the family offices, all the billionaire investors invested just like everyone else, with 60-40 portfolios of stocks and bonds. Okay, 1985. And then a guy came along named David Swensen. Okay, he was this 30-year-old manager of the Yale Endowment, inherited $1 billion, not a very big endowment, and said, you know what, this doesn't make any sense. That private alternatives are far superior. And he over about a 35-year period completely, just demolished everyone else in his success. He earned 13.1% returns on average for 35 years at a time when everyone else made 8.8. And he did it through private alternatives. Well, it completely rocked the billionaire, landscape. And today everyone emulates his models, and they invest 50 to 60% in private alternatives and 20 to 30% in the public markets. And so what I did in the book is trying to make these alternatives approachable to normal accredited investors, right? How do you get into these things? And real estate, private real estate is a good example of the first place to get started. It's level one, and we call our investment continuum. And what happens is when you invest in these private alternatives, they basically don't have the drawdowns. They have higher returns and lower risk, okay, than the public markets. And what happens is when you buy things that zig when other things zag, right? Your overall portfolio gets safer, and you can either use that safety to get higher returns or less risk, or both. And that is the key of what they're doing. So I'm teaching people how to do it. I'm teaching them about all the different the five different alts asset classes, what their superpowers are, how they function, how they work, when they work best. I go through tons of historical data. Anyone that knows me knows I'm a complete data nerd, and I show how they performed in the last crashes and how they perform in the boom cycles, how they compare to the stock market, and their superpowers. What do they do that is unique, that you can use in your portfolio? And for example, real estate superpower is inflation, right? It's got a couple superpowers. It's great tax benefits, but it is the ultimate way to beat inflation because it's easy to lever, and you get a multiple of inflation as a return. So
you've been doing this for a long time and educating people in this long time. And so the average Joe retail investor, I mean, they're just kind of buying into the stock market. I mean, that's most of probably what people do. Maybe they have some hard assets, and they buy personal real estate. But they're not actually investing in some of these, private investments, and stuff like that.
That's the point of the book is to help people make that jump.
So what are the biggest misconceptions of alternative assets that the objections that you've received as you're out there raising for money, as you're preparing these deals? I mean, what are kind of the big hangups for people?
Is it a Ponzi scheme? Right.
Right. Okay.
I think it just doesn't feel approachable. I think people don't feel comfortable. I mean, they don't necessarily know, what the risks are. And meanwhile, they may have a financial advisor telling them, whatever you do, don't put money in that real estate deal. Although investors, it's like, how many of you know what your REIT is actually investing in and what their leverage ratio are and what their debt structure is? People don't know this stuff, right? You don't know. You just think, because it's a public company, therefore it's safe. Yet I've bought public companies and lost everything in public companies. Right. So it doesn't make it safe, right? And Amazon, during the dot-com crash, dropped to 35 cents a share in today's share price. It's like people got creamed. People lost everything in even what was a good company at the time. So I think people just don't feel comfortable because they don't feel like they understand it.
I feel like one thing I hear a lot is like, what do you say to the person that's like, hey, your fund is generating 9%, great, stable fund. They're like, well, I can just keep my money where it's at and it's earning 8.5% or 9% in this index fund. I mean, I feel like I get that kind of feedback all the time, and they're saying, hey, how diversified it is, and they feel really comfortable in it.
Well, that's a person that doesn't understand what they've invested in. They do not understand the index funds. Okay, they don't understand how it works. Yeah, and that's a person who he doesn't have any gray hair.
That's the person that's probably just believing whatever
I've lived
the financial
through
advisor
four market
is
cycles.
Telling them.
Okay, 4 market cycles. Okay, and trust me, they are ugly, and you'll get creamed. And the market is frothy as this market is. I promise you, markets don't go up forever. And there's going to be massive corrections, and people are going to get creamed. And it's a sure thing. Bubbles have always been a part of the financial landscape. I'm actually a financial historian. You look at the South Sea bubble or the tulip bubble. It's like people get a narrative, and this narrative has some reality to it, and it starts getting frothy. And pretty soon, when everybody is bullish, who is left to buy?
So
right?
that brings up an
that's what
interesting
happens.
point. we've already touched on it, but AI is just like blowing up like crazy right
Right.
now. All sorts of new AI companies, all sorts of new AI, backed technologies, are popping up just literally everywhere. I mean, every day there's something new coming out. Would you
Right.
think we're in a bubble because of that? I mean, it
Yeah,
seems like
definitely.
you can't, like you said, it can't keep going up forever. And Nvidia has just been blockbuster because of it. All the chips that they're selling. So what do you think realistically is the outcome? I mean, do you think there's an option for it to just slow down and kind of be something more sustainable, or do you really think we're going to see a correction in the market for the AI stuff?
And okay, so let's talk about two different things: AI, the technology, and AI, the investment.
Yeah.
Okay, AI, the technology is going to change the planet, no question. AI, the investment,
Yeah.
I promise you, whoever is the winners today are not going to be tomorrow's winners. Do you remember social media? Do you know who the first social media players were? MySpace.
Yeah.
Do you know who the first internet, the big guys who pioneered the internet? Do you remember who they were? America Online and Netcom. They don't even exist. Do
Yeah.
you remember who the big search engine before Google was? Yahoo. Anybody who looks at this that realizes that the players who are get early headlines and market share are rarely the players that actually win the game. And we don't know. I mean, it could be some new chip comes out,
Right.
who knows? And it's all of a sudden everything evaporates. You look at Google. I mean, what was Google going to do if they hadn't pivoted to AI when everyone's using AI to search now and not a search engine? And you think a year ago they were completely unassailable, right? And all of a sudden they're
Right.
vulnerable. And this is a $1 trillion company. And so, it's a very hairy landscape, and I promise you, there's frothiness. The valuations are extremely high. I mean, I am a total quant trader. I've built computer programs to trade and look at analytics in the stock market, et cetera. And one of the very simple measures, if you look at PE ratio, the price to earnings ratio, which is really a yield figure, right? What's the yield of the earnings yield of the S&P 500, and you look at the next 10-year returns plotted against that, whatever, what is the PE ratio, and then what are the 10-year returns? Well, it's a reverse, correlation, as of course you imagine. And right now, at the current PE ratios, you would expect the future 10-year earnings of the S&P 500 to be basically zero. So, the stock market is not a place you want to put all your capital, for
Yeah.
sure. And, I mean, my daughter's excited about it because she just, bought some Nvidia, and
Yeah.
and she's like, just super pumped. I'm like, that's awesome, honey.
She's
But
like, I'm a genius investor now.
exactly, exactly. Luck has created more geniuses, hasn't it?
Yeah.
And
Well, it's similar to
know,
anybody that bought real estate in 2019 and, right before the run up, these last couple of years. I mean, everyone was like, I'm a genius.
right.
I can't lose.
I'm a genius. Right. Yeah. And I firmly believe that the best investment strategy is luck. It really is. And, but
Well, and luck is really just taking enough hits at bat. If you just keep doing the right things and the fundamentals, you're gonna hit some home runs, and you're gonna have some really good opportunities and really good deals come your way.
Yeah, that's right.
So that's interesting though. So, well, what do you guys see in Aspen Funds, and for you guys, what are you looking forward to? Where do you think the markets are shifting in 2026 and maybe even the next few years? I mean, what kind of investments or strategies are you going to continue to lean into moving forward?
Yeah, we've got a few strategies at play. Last year, or actually 2 years ago, we started a private credit fund, which does real estate private credit. And in the real estate crash, there's a lot of opportunities in that crash, even while real estate prices are very soft. And the primary, because real estate is a great place to be, there's a lot of people spending money, and is a good growth story there. So the way we wanted to play it is by lending. So we started a lending fund doing preferred equity and
Okay.
mezzanine debt. And the thing is on fire right now. It's doing fantastic. And so it's basically getting equity-like returns, but it's taking debt-like risk. So what we did is in this risky kind of environment, let's let's take our risk down, right? And we were able to put together
Yeah.
this fund to play. So that was our strategy last 2 years, and it's been great. Going forward, we still, I don't see necessarily the real estate market recovering fully next year, 2026, but we still like a couple plays. So we really like industrial. So big box industrial. This is playing the reshoring trend, right?
Mm-hmm.
So companies are moving back to America, and we've seen industrial has been, it's been fed by e-commerce, the e-commerce trend. And so it's never taken the big hit that multifamily took.
Yeah.
And so we basically buy a lot of land, we pour walls, tip them up, slap a roof on it, and lease it out to a credit tenant, and then sell it. And we've been doing that. We're one of the largest landholders now in some key markets in the Midwest along the I-35 corridor. And we're just going to town doing industrial builds.
We're seeing a lot of that even in our area.
Yeah.
A lot of along the I-75 corridor coming up
Yeah.
through Lima. I mean, really
Yes.
getting filled in, even in some of the, tertiary markets. The smaller markets are starting to really get filled in, and it's been kind of interesting to see.
Seth, it's not a trend that's going to stop. What's happened is the world started globalizing in 1945, and it was steadily globalizing until about 10 years ago. And what that means is that trade becomes more important, right? That you specialize in certain geographies like China, whatever, in manufacturing, and you build this import-export network. But what happened is COVID exposed the risk, right? COVID realized that the world has mispriced the risk of supply chains, all right? And it's completely mispriced. And so now what's happening is the world is repricing all of that and realizing that we've over globalized. I mean, look at the whole, magnet thing with China, right? The rare earth magnets. It's like the amount of risk in the planet is enormous. Same with chips, same with a lot of things. And so what's happened is there's a massive trend of deglobalization that's going to take 5 or 6 decades to get back. And America is going to be a manufacturing power again. And it's underway. It's a very, very big trend that's only at the very beginning. And so one of the things they're going to need is industrial real estate. And the real estate we're building can be logistics, it can be storage, and it can be manufacturing. It's the same building, same design.
Yeah. Well, I know we've been kind of a little bit of everywhere today, but what's kind of, before we move on to some of our other show segments here, what's final advice for our investors in today's market? What should people be looking to? I mean, I know you guys have stuff open, at Aspen Funds, stuff like that, but I mean, where do people really need to pull their head out of the sand?
Yeah. Well, I'll give you one we haven't talked about, and that's oil and gas. The most mispriced asset in the planet today is producing oil and gas real estate. We're buying these things at a 20% cash flow right now. I mean,
Wow.
What real estate can you buy at a 20% cash flow unlevered, a 20% cap rate, if you will? And it's the most mispriced asset in the globe. It's a generational opportunity for a lot of reasons because of a narrative that we are post fossil fuels, and we are not. The world is not post fossil fuels. I wish it were, but it isn't. And I think with the real estate challenges, rather than just looking at the buffet table that's empty in front of you, the real estate table, why don't you look at a couple other tables behind you that maybe it's time to branch out a little bit and diversify a little bit, and which is smart anyhow. Play the billionaire game, right? And get familiar with a couple of these asset classes.
100%. All right, we're going to jump into our smaller pocket segment. So, Bob, why don't you tell us about a deal that has gone wrong? It could be a deal in your personal portfolio. It could be something that you guys have tried with Aspen Funds. Go ahead and tell us about something that went wrong, and then most importantly, what did you learn from it?
Yeah. Yeah, I've got a few clinkers in my portfolio that, I mean, I think having been around a while, but yeah, I always like, I'm a computer scientist. I like the Bitcoin space, and I thought, hey, rather than just buy Bitcoin, let me buy a Bitcoin mining company. So
Okay.
I bought a private Bitcoin miner, and this super smart young man, and they raised $100 million or something, and went and bought Bitcoin miners, and were managing these miners, and this guy had was going to town doing super well. And then what happened, if anyone knows about the mining space, is all of a sudden energy prices started rising, and the guys that are running these data centers started raising their prices, and all of a sudden it just got really challenging and very difficult to make money. And the guy literally packed up and walked away.
No
So
way.
the manager walked away from the business. He wouldn't communicate with anybody, and even the wallet that held all the Bitcoin, it still is there. It still has the Bitcoin. No one knows how to get into it. He simply walked away.
So where the hell leave everyone that was a part of this?
Exactly. In a massive confused, investors don't even know who the other investors are, you know, um, and there's lawsuits happening, but the guy's disappeared, and so it's just a giant enormous mess.
Oh my word. And so that's still unfolding. I mean, you don't have quite the end of
Yeah.
that story yet, but I mean, um, but everybody's money is just tied up right now, I guess, in the equipment and then
Oh,
also
it's
in the
evaporated.
wallet.
It's
It's
gone.
just
It's
gone.
worthless. It's
Wow.
worthless. Yeah. Yeah. Because all the equipment, as soon as though that's happening, the equipment was a quickly depreciating asset
Yeah.
anyhow. And then because there's always a new model that gets more
Yeah.
pricing. So it's like an old iPhone, right? The stuff just really goes nowhere in value. And Bitcoin, because of the halving and everything, it gets more difficult. So it's a zero. It's a complete wipeout. And unfortunately, had he worked his butt off, he probably could have returned most of the investors' capital.
Yeah. So what was your big takeaway from that for you personally?
Well, so here's a guy who the fund was designed so he took 50% of profits, 50%, and he did no co-investment.
Oh
So
wow.
he didn't, but think about it. If you start a Bitcoin mining company and you've got, you made all these projections for the millions and millions of dollars you're going to make, are you going to put your own capital into it? If you're making 50% returns, you aren't. And so, in my book, I say the number one way to do due diligence, or the poor man's due diligence on your sponsor, is co-investment amount.
Yeah.
Is you want to make sure your sponsors put their own skin in their investments on the same terms as the investors do. And if they're not willing to do that, it's not a good enough deal,
Yeah.
right? And if they're great deals, they should be eager to put their capital to work, right?
Right.
But here's a guy. So, when you invest in a fund, the sponsors have carry, right? So they participate in the profits. So in that way, you're aligned. But they don't participate in the risks,
Yeah.
right? And so what happens is a guy that has no co-invest and only carry is incentivized to take a moonshot and not incentivized to manage the risks. And this guy would never have walked away. Had he had, 250 grand of his own money in the thing, he would never have walked away. He would
Yeah.
have fought for it. And so that's the thing is that's the big takeaway was don't ever invest a dime in a deal where the sponsors are not co-investing.
Wow. Yeah, that is crazy. Yeah, that's an interesting one. We haven't had one about a Bitcoin disaster. So that's great. All right, we're gonna move into our little nugget. So, what's one practical piece of advice or takeaway that our listeners can implement into their business? I know we've
You
talked about
know,
a few things already, but something kind of maybe different or fresh, or something that you specifically are like, man, this has been a mantra for me.
you know what? I'll do something a little bit out of the box. So something I'm thinking about right now, okay, is I tell investors to make a hub LLC for their investments, right? So you move from a little, Bob Fraser LLC, right? And you put your investments in there. And by the way, that has no employees. And by the way, it's a business. and it can have a solo 401k. And you should be putting your own solo 401k on your own investment business. And you can tax defer and invest tax deferred up to $75,000 per person. And if your spouse is in there with you, that's $75,000 each in tax deferred vehicles. And if you're not paying attention to solo 401ks, it's like a supercharged IRA. Doesn't have any of the problems like UBIT. You can also borrow against your 401ks, and you can do self-directed 401ks. And so it's just one of the many strategies that I have in my book about, tax and everything else.
No, that's great.
Structuring.
Something definitely good for people to look into. I know, are there only certain companies that allow you to do a self-directed IRA?
Yeah.
Okay.
Now, this is different than an IRA. It's a 401k.
401k, self-directed 401k. Sorry.
Yes. Yeah. And IRAs are limited to, if you're older, you can put $8,000. And your income limited. 401ks and solo 401ks are not limited, and you can do 10 times the capital. You can put 10 times the capital into them. They don't have UBIT problems, and you can borrow against these things. So you find a custodian that does this, and it's a 401k. It's designed for business owners to create their own pension, because assumingly business owners don't have a pension, right? And so it's a way to do your own, and it's far superior to IRAs and far larger. And there's really no downside to them.
Yeah, that's awesome. Well, I've really appreciated our conversation today. I know we got into a lot, but I think there's a lot of stuff here that just kind of keeps people updated on where things are at in the market, and then where you guys are at, and kind of something to look forward to coming in these next few years on where should you be considering investing your money. I mean, get outside the box. Don't fall into the trap of just working for 50 or 60 years and just always throwing it into the market and not really understanding where your dollars are going and what's actually going on. So we thank you for sharing with our audience. And before we get out of here, what's been the best resource for your business development?
I don't understand the question.
Yeah, like, is it a book, a podcast, a person? I mean, what's been the best resources you've been developing yourself and your business? I mean, what's maybe something that someone should look into?
Yeah. What changed for me was really, I got into John Maxwell, and I just really encourage people to read some of John Maxwell with the foreword for my Invest Like a Billionaire book. Very cool. And his stuff is amazing. Just about leadership. He said everything rises and falls on leadership. And I think we should always be upgrading our leadership game.
Yeah, no, that's awesome. No, he has some great stuff out there, and actually my father-in-law quotes that exact thing constantly. So, no, that's great. And where can people follow your success, Bob, and find out more about you and your company?
Investlikeabillionaire.org, and that's our portal, our investor portal. You can buy the book, and also my firm is aspenfunds.us if you're interested in our investments.
Awesome. Well, thank you so much for coming on today. And everyone else, we look forward to seeing you next week.
Pleasure to be with you today.
As always, excited that you joined us for another episode of the Reinvest Podcast. If you want to learn how you can use your hard-earned capital to diversify into real estate, go to our website, reinvestcapital.us, and shoot us a message. Move farther, reach higher, and grow deeper.